Dear students, welcome you all to the session 2 video of Financial Management 5th semester BCom. In session 1, we discuss the meaning of financial management and its relationship with other disciplines. Financial management is the application of principles of management to the area of finance. That is, it is concerned with the planning and controlling of financial resources. We have seen that financial management is an integral part of overall management and there is inseparable relationship with the production, marketing, human resources, research and development, etc. In this session, let us discuss the scope of financial management. There are two approaches. One is the traditional approach and the other one the modern approach. The traditional approach. Financial management as a discipline is derived from economics. In the initial stages, the subject itself was known as corporation finance. This approach limited the role of financial manager to raising the funds, that is acquiring the funds, which means that the financial manager's major responsibility is to acquire or get the funds from various sources or institutions. So the financial manager must have a clear understanding of the different institutions from where the funds can be raised, as well as the various instruments like shares, bonds, etc., through which the funds can be raised. So another aspect was regarding the reporting, that is the financial manager had to see that the annual reports are audited as well as published. The problem with this approach is that this approach actually narrows the scope of financial management. That is, it says that the financial manager's task is only raising the funds. So, this approach suffers from certain limitations. So, the main limitations or drawbacks of traditional approach are corporate bias. That is, it is concerned about the finance of joint stock companies. As I have told earlier, the subject itself was known as corporation finance. That is relating to the financial needs of companies. The management of finance of a partnership firm or a cooperative organization did not come under the purview of this approach. In this approach, the emphasis is on raising the funds. That is, the task of financial manager is to acquire the funds. Now, usually when do we raise the funds? It's only during the major events like restructuring or mergers or acquisition. The firm experiences such situations once or twice in the lifetime, isn't it? So, the routine activities are not given any importance in this approach. This approach gives more importance on long-term financing. So the finance of current assets or working capital management is not given any importance. So in short, we can say that the traditional approach narrowed down the scope of financial management. So we have a new approach, that is the modern approach. The modern approach of financial management is concerned with the acquisition of funds and efficient utilization of the funds. The financial manager's task is to get the funds from various sources as well as to see that these funds are utilized properly, efficiently in the organization in order to achieve the organizational objectives or objective of maximizing the wealth of the shareholders. So modern approach is concerned with the acquiring of the funds as well as regarding the utilization of the funds. So in a modern organization, financial manager has to take some important decisions. So we call it as the financial decision areas or finance functions of finance. So these are the investment decision, financing decision and the dividend decision. So these decision areas are interrelated. Now let us see one by one. The investment decision. Investment decision means the decision to invest the funds in various assets. That is the selection of assets in which the funds will be invested by a firm. The assets of the firm will be maybe a long-term asset, that is fixed asset, or it may be short-term assets. Long-term assets yield return over a longer period of time in future. So such decisions are very crucial in nature. So such decisions are known as capital budgeting. Short-term assets or current assets are those assets which can be easily converted into cash within an accounting year without disturbing the operations of the business firm. So decision relating to the current assets are known as working capital management. So investment decisions are classified into two types, that is a decision regarding the long-term assets known as capital budgeting, decision regarding the short-term assets, that is working capital management. The second decision area of the financial manager is the financing decision. So the financing decision is concerned with the capital mix or the capital structure of a firm. So what is this capital structure? It is the proportion of debenture and equity share capital. So financing decision of a firm relates to the financing mix. The financial manager must take into account the cost of capital, risk and return of the shareholders. Employment of debt in the capital implies higher return to the shareholders, at the same time higher financial risk. So there is a conflict between return and risk in the financing decision of a firm. So finance manager has to bring a trade-off between risk and return by maintaining a proper balance between debt capital and equity capital. The third decision area of the financial manager is the dividend decision. Dividend policy decision are concerned with the distribution of profits of the firm to the shareholders. That is, how much of the profit should be paid as a dividend, that is called as the dividend payout ratio. This decision, that is the decision to pay out dividend to the shareholders, depends upon the preference of the shareholders as well as the investment opportunities available within the firm for future expansion, etc. So the dividend payout ratio is to be determined in the light of the objectives of maximizing the market value of the share. The firm, the financial manager has to decide how much of the profit should be retained in the organization or how much should be paid out to the shareholders. So the three important decision areas are, once again, it is investment decision, that is their decision to invest the funds in various assets, that is selection of assets. Once you have selected the asset, you need to know what are the various sources of funds and how to get those funds. That is the financing decision, the second decision area, financing decision. Whether you need to get funds through issuing shares or issuing debentures or going for a long-term loan, financing decision, decision regarding the sources of funds. The third decision is the dividend decision. Having acquired the funds through various sources, now you have to decide whether the profit should be given to the shareholders, whether it should be distributed to the shareholders or whether it should be retained in the organization. So these are the decision areas or the finance functions: investment decision, financing decision and the dividend decisions. Thank you.